For more than 20 years, Australians have been warned the housing crash is coming. The so-called experts lied and are still lying. Every second YouTube video is some guru predicting what they know in reality won't happen in any hurry. They'll eventually get it right one day, of course, when a modest crash comes. They'll try to say that they predicted it ages ago, but that was for back then. Egg on face. As for other people, economists said prices were unsustainable. Politicians promised affordability. And yet, the crash never seems to arrive. Today, we're digging into why housing prices keep defying gravity, even when logic and debt suggest they should fall. Because behind the endless boom is a mix of policy, psychology, and economic theory that keeps this market rising, no matter what. Let's start with the numbers. Since the early 1990s, Australian house prices have increased more than six-fold, far outpacing income growth. We've had interest rate hikes, global financial crises, pandemics, and yet every dip is temporary. Why? Because in Australia, housing isn't just shelter, it's a national wealth engine. Nearly 60% of household wealth sits in residential property. That means both homeowners and policymakers have an interest in keeping prices rising, or at least stable. Every time the market slows, policy acts like a safety net. Interest rates are cut. First homebuyer grants return. Tax settings like negative gearing and the CGT discount stay untouched. This creates what economists call moral hazard. When investors believe the government will step in to prevent a crash, they take on more risk. In short, housing is too politically important to fail.
One key concept here is asset price inflation. While the Reserve Bank focuses on consumer inflation, groceries, fuel, services, it largely ignores asset inflation, like property. And because land is finite, in the cities at least, returns on land ownership outpace wages over time. Simply put, as population and demand grow, the economic surplus goes to the landowner. That's why you can work harder, earn more, and still be priced out. Another crucial concept is the idea that stability itself breeds risk. When people believe the market will always rise, they borrow more. Banks, confident in rising collateral values, lend more. And this feedback loop keeps prices climbing until debt itself becomes the market. In Australia, total household debt is now more than 180% of disposable income, one of the highest ratios in the world. Yet as long as credit keeps flowing, the system keeps running. Of course, we often hear, it's just a supply issue. But that's only half true when land zoning and speculation matter more. Developers and investors sit on land banks waiting for appreciation. Local councils restrict density in inner suburbs. So while population rises, usable supply barely moves. This is known as land rationing, and it keeps prices high even when new builds increase. So why doesn't the crash ever arrive? Because every mechanism that could bring prices down, interest rates, tax reform, lending standards, gets reversed or softened before true correction. And psychologically, no government wants to trigger negative equity for millions of voters. In effect, the system has evolved to socialize risk and privatize gains. So long as credit and policy inertia continue, the so-called crash remains just out of reach. Australia's housing market is often called a bubble, but it might be better described as a permanent policy project. It survives because it has to.